this week's edition of Talk on Nevada. I'm Andy Matthews. Joining me this week is Geoffrey Lawrence, fiscal policy analyst at the Nevada Policy Research Institute. Jeff, welcome.
Thanks, Andy.
We've been talking a lot in recent weeks about the local economic situation here in Nevada, and I want to shift focus a little bit to the broader picture. The backdrop for a lot of the debate and discussion about fiscal policy here in our state has been the broader economic recession. Briefly, for our viewers, what was the real cause of this economic recession? And do people even understand or recognize, in general, what that cause was?
Well, no, I think there's been a lot of confusion, even among some of the more informed observers about what the cause of the recession has been. And the main problem is that many observers have been diagnosing the symptoms without diagnosing the disease. And that underlying disease is the fact that the Federal Reserve has pursued a very expansive monetary policy over the past 15 years or so. And what that's done is it's sent a signal to investors that there's more savings available within society than is actually the case because it's suppressed interest rates. And that's led to a series of malinvestments across the economy that's led to the use of productive resources getting soaked up by sectors of the economy that really wouldn't bear out that level of investment on a market basis. And what that does is it creates what we call bubble markets. At first we saw this with the dot-com bubble, for instance. Now we've seen it with the housing bubble. So that really has been the underlying cause.
So there seems to be a consensus developing that these bubble markets are a real problem. How do you prevent them? I mean, if you're in charge and you're setting policy, what do you do to prevent these bubble markets from being created?
Well, to some extent, bubble market, just the business cycle in general, going from a boom period to an ensuing bust period when those bubbles burst, to some extent that's inherent to any financial system that's characterized by fractional reserve banking, because you have a series of credit expansions, and some of those credit expansions don't bear out, and then you have credit contraction. Now that problem is exacerbated many times over when you have a central bank that is constantly injecting new liquidity into the system. So they're creating new money, which in a way, it's a falsified sense of capital, and a bubble cannot really exist unless a central bank is constantly injecting that new money into the system, which allows investors to bid up the value of a specific asset.
Now, to be fair, Jeff, that's one theory, your theory on why we're here, what we need to do. But certainly there are competing theories out there. Just run down what some of those are, some of those competing theories.
Well, probably one of the most prominent theories from a different school of economics is the Keynesian school. Now, they believe that the root cause of recession is a collapse of aggregate demand. So what they're saying is that individuals and families all of a sudden become less willing to buy products to feed their family, put a roof over their heads for some unexplainable reason. Usually they use the term irrational exuberance without really explaining what that term means. Now, it's part of the policy prescriptions that they apply are things that would basically prop up government spending, and in other words, they'd be taking the choice about spending out of the hands of private individuals and put it in government's hands. And as a side effect, this just kind of allows government to expand in both size and influence over people's lives. So it's generated a lot of support among policymakers because it gives them an excuse to pursue basically any program that they want, because they have this intellectual foundation that says any amount of government spending is good and even more government spending is better.
Now that's on the spending side. On the tax side, in regards to setting tax policy, the proponents of this other theory you're talking about, what would they recommend and why are they wrong? What is it that you think we ought to be doing in terms of setting tax policy?
Well, one of the things that they want to do is they want to take the spending choices out of hands of private individuals and put it in government's hands. So what they'll do is expand government spending dramatically in order to prop up what they see as demand just in the present, because they have a very limited time horizon. They basically discount the value of savings for the future, things like investments in new machinery or new technologies. They just want to basically have a static economy that goes on through time like that. And so they'll expand government spending, and as a component of that, they generally have to increase taxes at the same time in order to finance that spending. Now, at the state level, that's more pronounced because in Nevada, as in many states, there's a provision that requires the state to have a balanced budget. So if there's a massive increase in spending, as we've seen in this legislative session, there also has to be a massive increase in tax base, as we've also seen in this legislative session with a historic 20% increase in taxes. Probably this has a lot of adverse impacts because basically the point of these Keynesian policies is to prevent the market correction from happening. They want to keep the market from reallocating resources back towards a level that would reflect true demand. And they want to keep productive resources locked up in basically these bubble markets, right? So the economy never returns to sound fundamentals, and the effect of if a Keynesian policy is truly working through these fiscal stimulus plans, then what you should see is the recession gets dragged out because this healing process never occurs. So what happened, for instance, in the 1930s here in the U.S. when a recession that probably would have been over in a short time period was stretched out over an entire decade. Probably a much better policy response is to allow that necessary market correction to occur. There might be some short-term pain, but in the end, you get that realignment of resources that you need, and you'll have long-term growth and prosperity. So the best response that government can do is to exercise a policy of fiscal restraint, allowing people to save and invest for the future, and building up those the sound fundamentals, allowing productive resources to be used in their most productive capacity.
And of course, that would mean, as far as the tax issue, from your point of view, if Geoff Lawrence is setting policy, we're not going to be raising taxes.
No. In time of recession, that's the worst thing that you can do because higher taxes put more people out of work, and then you of course have the excuse for ramping up government spending again, and basically you create a system in which people become dependent on government.
And like you said, it exacerbates the problem.
Yeah, and it's a perpetual cycle. It just gets worse and worse.
All right, well, Geoff, we're going to have to leave it at that for this week. I want to thank you for joining me, and look forward to talking about this a lot more down the road. I want to thank all of you for tuning in to this week's edition of Talk on Nevada. See us online at mpri.org for more information on this topic and other private solutions to public challenges facing our Silver State. In case you haven't done so already, make sure while you're there you get tickets to MPRI's 18th anniversary celebration. Come see Karl Rove on September 23rd at the Venetian. Thanks.